All right, what's going on, guys? Welcome to the video. This is your free training, and in this video, I'm going to show you guys my entire trading strategy, really. So, obviously, I'm not going to be able to cram years of trading experience and strategy and whatever into one video that's a reasonable length. So, I'm going to try to keep this as quick as possible, but I want to make sure that you guys get as much value from this and you come off this, video and you actually really understand the strategies that you can start applying them right away and making money with them, right? So I'm going to go into the strategy I use for trading S&P 500 during New York Stock Exchange Open. So I only trade S&P 500 during New York Open. I don't trade it really outside of the New York session. I try to find a trade right around opening bell in the first, couple hours of market open. But every once in a while, I will, find a trade during PM session. That's just me being honest with you guys. But here's something that you guys can start utilizing to capitalize on the volume that's coming into the market New York Open. And then I'm also going to go into the first ever Forex strategy that I learned, which is also smart money that, really helped me become consistent in the market. And I'm going to show you both of that. I'm going to show you guys the examples of both, and hopefully you guys get some value from this. So before I get into showing you guys the examples and the strategies, it's really important to know that these markets are 100% manipulated, and we as retail traders, we're just trying to get in for the ride, so to speak, with the banks, the hedge funds, the institutions, the big money market makers, really, that are actually moving the markets, right? So I'm gonna say some things that maybe if you're brand new, this might go over your head in terms of like liquidity or imbalances, fair value gaps, order blocks. If you guys don't know what those terms are, don't worry, don't be intimidated. Yeah, I didn't know what those meant at one point either, right? So you'll learn, and in this video, hopefully I can simplify some of that stuff for you guys. So let's go ahead and jump right in. And basically, guys, I have some examples that I want to show you guys. And the reason I'm doing it like this is because if I were to just scroll and backtest on TradingView, this recording would end up probably being like well over an hour, and I don't want to do that. And I know you guys don't want that either. So I'm going to do two examples on S&P 500, and then I'm going to get into the Forex strategy that I want to show you guys. So number one, guys, step number one with this strategy is finding my daily bias. Now, obviously, even before this, you want to make sure that you check the news. I use Forex Factor. You guys can see that I have a bookmarked right up here. So this is what I use to find all my news data. I'm making sure that there isn't any high impact news events that are going on, like CPI, like PPI, like PMI, like NFP, all those types of things. You want to make sure that you're not trading during those times, because you're just going to be, all concepts like this go out the window when you're trading in those times. So you always want to make sure that you're not trading during high impact news. And then once you have established that you're not doing that, then step number one is finding out your daily bias. The way that I find my daily bias is I go to the 1 hour time frame on S&P 500 or SPX, and I'm looking at structure. And as you guys can see, the current structure that we are in is bullish for our bias. The reason that we are bullish for this bias is because we can see here we have some down moving candles, and we see this push up with a close above these highs. So this is bullish, right? In this example, this is what bearish would look like. Why? Because this is the last up candle. The moment this candle right here closed below here, below this low of the last up candle, this moved into bearish structure on the 1 hour time frame, right? So looking at the 1 hour time frame, pre-open, this red line is opening bell, 8:30 a.m. Central, and 9:30 a.m. Eastern Standard Time. So that's what we're waiting on. So we're looking at this pre-open. We're deciding that we're bullish, and all that means, guys, it doesn't mean that we can't ever look for sells, right? It just means that if we're going to lean one way or another going into pre-market open, then we can lean more towards the buy side for the day because we're bullish on the higher time frame structure. So getting into the next step, our next step is finding liquidity. Okay, so dropping down to either the M15, the M5. I like to use all these time frames, guys. I'll drop down after finding bias to the M15 and the M5 to mark out liquidity. I don't really go lower than that because I want to find significant or somewhat significant highs and lows for liquidity. And all I mean when I say liquidity, guys, you can think of it literally as highs and lows. And if you have equal highs and equal lows, aka meaning more than one touch in the same area, that's even better. But you really only need just even individual highs and individual lows, because basically the way that you can think of liquidity, guys, is fuel for the next move. Why? Because retail traders are looking to buy off of these levels of quote unquote support. That's what they look at them as. And they put their stop loss just below. And you have stop or breakout traders that are putting their stop orders, their pending orders, right below here, expecting to take the breakout. Either way, what this is accomplishing when these levels get ran through is it's triggering stop losses, and it's also getting other traders into the market in order to fuel the next move, because the banks, the hedge funds, the big money movers, the market makers, right? They need our money in order to fill their positions. They can't just get in and out wherever they want. They need money to do that because they're trading with millions and sometimes up to billions of dollars, right? So here's number one, is finding sell side and buy side liquidity, highs and lows. Okay, so this is what it would look like pre-open on the 5-minute chart. And you just have buy side liquidity right here, right? You have sell side down here and right here. So from there, guys, move on to the next step. The first thing we want to see before taking a trade is a run on liquidity. So I drop down to the 1-minute chart. Once I see that we've tapped into or ran through that initial level of buy side or sell side liquidity. So once I've done that, I move down to the 1-minute chart, because in order to get the best entry possible, you need to be on the smallest time frame possible, right? So here's how this will work. So step number 3, you wait for the sweep, which we got right here. We drop down to the 1-minute chart, and now we want to see a break of structure happen. So in this example, I'm going to preface it before I show you the actual, chart itself. This is the last candle, right? It moves down and then it comes into this candle wick. So this candle opened up, pushed down initially, grabbing this liquidity. What did it do down here? It hit stop losses, right? People that were trying to buy right here, they put their stop loss just below. Boom. Those people got stopped out. But what else was under here? There were sell stops, right? Sell stops were under these lows for people that were looking to take a breakout to the downside. So now what the market has done is stopped people out and also gotten people in. And then what's it looking to do? Go the other way. The people that just got triggered in to go down are now in drawdown, losing money as the market's getting ready to go to the upside, right? So that's kind of the idea. So if I show you guys how this would look in terms of your break of structure, so you guys can understand it, here's how you would draw this up. So this is the last candle that we were talking about, right? That grabbed liquidity, and then we got a bullish move up. The next candle, we get a down move. Okay, great. So that means this is our high that was just formed. The most recent high on the 1-minute chart after the liquidity sweep was formed right here, because we had an up candle followed by a down candle. And if we were looking for a sell, the next example I'm going to show you guys is a bearish example. So you'll get to see how it looks the other way, but it's literally the same thing vice versa. So mark up the line right here, the red break of structure. Right? I use red for these break of structure lines. You can use whatever color you want, but basically this is what the trade would look like. You would anticipate, you wouldn't know for sure that the market's going to do this, but you would anticipate this happening. Why? Because you got the liquidity sweep that you already had marked up, boom, ran through, and now we're waiting to see a break of structure happen for our trade. So break of structure would come right here is where we would anticipate it. And then we could look for our trade. So if we see how this plays out on the next screenshot here, boom, price runs up on this candle, closes above the break of structure. So that's boom, that's what we want. We want to see a candle come up and close above this wick. If the candle came up above it like it did here, and then it came all the way back down and closed below the wick, that's not a break of structure. You need a candle to close above the wick, the very highest point of this break of structure area, right? So you can enter the trade the moment that happens. The way that I decide if I'm entering right here is depending on how far price pushes up past the break of structure, because if it pushes up a couple of points and then closes, I'm not looking to enter right there. Why? Because my risk to reward will be terrible. My stop loss will be huge. And at that point, you can either, wait for a pullback to an order block, or you could wait for a pullback to a fair value gap if it leaves a fair value gap behind. And for those of you guys that don't know what an order block is, on this screenshot right here, it's this candle, the last down moving candle before the up moving candle that broke structure. So this is an order block. So if price had pushed too far away, you could wait for price to come back into the order block and then enter there, stop loss below the low either way, right? And then take it to the upside, right? So your take profit levels would just be, recent levels of liquidity. You could also target other order blocks for TPs, or you could target other fair value gaps. And just to give you an example of what a fair value gap is, just by looking at a chart. So you see these two candles right here. You notice how they're just like completely rising. They're buy candles all the way through with no selling going on, because they're just straight up with no other candles to balance them out, so to speak. So this is what a fair value gap looks like. This is what an imbalance looks like in the market, where there was no even amount or even distribution of buying and selling. It was all just either buying or all just either selling, right? So that's just a very simple definition in a way that you can look at a chart and spot these, pretty easily. And you can spot them like this on any time frame, and they're relevant and important on all time frames that you're looking at, right? So here we go. Moving on to taking the trade and hitting TP1. So boom, TP1 gets hit up here, which was this recent high. The way that I define my take profit ones is I'm going to target liquidity, or I'm going to target order blocks or fair value gaps. My personal rule is I want my take profit ones to be at least a 1 to 2 risk to reward, or very close to a 1 to 2. It doesn't have to be exactly 1 to 2, right? I would say anything above a 1 to 1.5 risk to reward, then you're good, right? But I mean, if you're doing a 1 to 1, or even less than that, I mean, it's really not even worth it. You want to look for a better risk to reward. And the reason for it being is because once we hit TP1, guys, I'm moving my stop loss to my entry. I'm going risk free. So even if price reverses and comes back, I'm good. I'm not going to take a loss, but I'm also securing about half my position at take profit 1. You don't have to do exactly half, guys. This is just what I do. You can partial however you want to partial, I would say, but what I do is take about half my position off. And if we're at a 1 to 2 risk to reward and I take half my position off, I've already secured, let's say I'm risking 1%. I've already secured 1% gain at TP1. I've already secured what I was risking on the trade at TP1 by doing that at a 1 to 2 risk to reward, right? So I'm going risk free here. I'm taking off half my position, right? And then for extended take profit levels, you're doing the same exact thing. You might have to scale out to a higher time frame for this example in order to find the next, highs or liquidity that I could target. I had to scale out to the 15-minute time frame, but you're literally targeting liquidity levels, aka highs and lows. You're targeting other order blocks. I marked up a couple order blocks so you guys can get a visual reference of what they look like. Last up candle before the down move that broke structure. Very simple. Last up move before the down move that broke structure. Very simple. Here's another fair value gap. Boom. All selling pressure right here. All selling. And this is all uneven. This needs to get balanced back out. The market is only ever looking to do two things, guys. Sweep liquidity, aka get money. And then 2, rebalance price. That is it. That's the only 2 things it's ever trying to do. And a lot of times they'll actually do both at the same time. The smart money is very efficient. Very, very, very efficient. The market is ran on an algorithm, right? And it's doing this over and over and over on repeat, okay? And then the other one is equilibrium. And all equilibrium is, guys, is if you take, 50% Fibonacci retracement tools, or 50% of a range from like a high to a low, that would be equilibrium. So it's the 50% mark of a range. So that's what equilibrium is. But here's where you could identify other potential TPs. So like TP2 would be this high right here, which is also lining up with a fair value gap. So that's an amazing take profit level because you got a couple in one. You got liquidity and fair value gap. Take profit 3, you have liquidity above this high, but then you also have this order block that we're running into, right? So boom, there's TP3. And then I marked up other levels that you could, if you were really wanting to hold on to this thing. I like to just kind of do like 3 TPs, sometimes 4 at most, if I'm really just wanting to hold on to a runner. But really, this is all you need, because if you take 50% off here, let's say you take another 50% off here, I mean, by the time you get to take profit 3, you're really not left with much. So I'm good just paying myself and just being done and getting, you don't need to get greedy and try to catch every, like, you don't need to get every little bit of every move, right? Like, you can just be happy with this. This is an amazing trade. This is I believe this is, when we look at the final result here, this is like a 1 to 5, right? From entry to, yeah, there you go. So this is a 1 to 5. Obviously you're taking partials along the way, but you guys get the point, right? Like, this is an amazing move. Entry was at, 40, we'll just say 40.99, or we'll just say 4100 for easy math. And then TP3 was 41.25. So we're talking like a 26 point move, which is amazing. That's incredible. That's 260 pips. So that's an incredible trade. You don't need to get greedy and hold on to it. You can if you want to. I'm not going to tell you what to do, but that's just what I do personally. So that's example number 1, guys. Let me clear these out. I know this is getting a little bit messy. If you're OCD, I apologize. It's all good, but let's go on to example number 2, and then I'll get into the Forex stuff real quick. So number 2, again, looking for the bias. We already confirmed we're not trading during news, right? So we're on the 1 hour time frame looking for bias. We are bearish with our bias, right? Here we had the push down, getting below this low, closing below this low. We're bearish. And now we're pushing up, correct? But in order for us to be bullish, this candle, or at some point, this would need to get up here on a 1 hour time frame and close above this high, this wick, because this is the most recent high, right? So we would have to get up here and close above it, and then we'd be bullish in terms of the 1 hour time frame. So right now we're bearish going into pre-open. Okay, so run back the same exact steps. Oh boy, let's see if we're gonna get it. There we go. So run back the same exact steps, right? Find liquidity. I'm dropping down to the 15-minute time frame here. Again, 5, 15. You just mark up the levels that are very obvious, right? They stick out like a sore thumb when you're looking for this stuff. High, low. Here's a low, right? And it gives you a big wick that's a super obvious. And then here's a high, right? And I just kind of mark up whatever's like recent, whatever's relevant to, price at market open, because I'm looking to find a move. So again, find the liquidity levels, buy side liquidity, and sell side liquidity levels, right? And then now step 3, we're waiting for the liquidity sweep to happen on market open. Drop down to the 1-minute time frame. We've got the sweep of liquidity, right? We're pushing up through. And we're bearish, right? So if we're bearish, that's actually exactly what we want. We're wanting to lean towards taking sells. So this is ideal. It's not always going to work like this, right? Sometimes you might get the opposite, and then you have to trade against your bias into the trade you actually want to take. But that's neither here nor there. Right now, this is exactly what we want to see. Price pushes up, grabs the liquidity, and now we're waiting for a break of structure. Or the other alternative is, if you were to get a sweep of liquidity on like kind of a smaller candle, and then the next candle you get an engulfing candle that engulfs the entire previous candle in your direction, that is also a signal to take a trade. And those are the only 2 things that I will look for to take a trade. But more often than not, waiting for the break of structure is going to be the highest probability that you guys can utilize. Okay, so right here, we wait for the break of structure, and we'll see how quickly that happens. I don't believe this one happens super quick. So let's go right here. Right, so okay, so price pushed up. The liquidity level was right here at this line, so you guys can see price pushed up through it, and then it went up another 2 candles before our first down candle. It actually almost got to this buy side liquidity, but it didn't. Price comes down. We get a down candle. Okay, great. Up candle. Awesome. Now we have our most recent low, to where as long as this high holds, which it's doing, right? As long as this high holds and we come back down, this is our break of structure. So price pushes down, closes below this wick, and we get the break of structure. And then here's the order block, right? So here's what you can do. You can enter again right off the break of structure. This is only about, I don't know, what is this? 0.75 of a point. So 3/4 of 1 point from this break of structure line. So I'm okay taking this trade at break of structure for sure. But let's just say, for hypothetical, you wanted to wait for the order block, right? And I tried finding a not so clean trade for this example to show you guys. So watch this. Okay. So we were just right here. There we go. So boom, price actually does come back, right? You could have entered right here. And if that would have happened, price chops around, and this is ugly, right? Sometimes this is how trades will be for you. And this is going to mess with your emotions. So I need you to prepare for this ahead of time. Not every trade is going to be a beautiful just runner, right, to take profit 3, right? Sometimes you're going to have some mental fortitude. And so let me walk you guys through real quick why you've decided to take profit 1 right here. Okay, so 1, you could have waited, got the order block entry. It did come back. Sometimes it doesn't come back for order block entry. Just a heads up. But you know, this is a great, if you miss this or you think it moves too far and you want to wait, a lot of times you're going to get a price to come back and fill the order block. But also right here is a fair value gap before the order block. Amazing, right? You could have entered on the fair value gap. You could have entered on the order block. All great. They're all right here, right? So stop loss above the high either way. TP1 is this order block. Now, some people would say, well, why wouldn't you TP1 right here? The reason I wouldn't TP1 right there personally is because it is not a 1 to 2. If it is close to a 1 to 2, I would definitely do that, right? But if it's like a 1 to 1 or a 1 to 1.1, 1.2, I'm just not going to do it because it doesn't make sense by the time price gets here that I'm closing out half my position, which was only half of what I was risking in the first place. That's terrible. I mean, if you do that long term, it's probably only a matter of time before your account's going to trend in the wrong direction. And that's just my opinion. So take that for what it's worth. So I want my TP1 to be as close to 1 to 2 as possible. This order block, which is another thing that we target, great. And it's 1 to 2. It was like a 1 to 2 exactly. Okay. So that's where TP1 was. You can see price came down, almost got there right off the rip. Right. And if that were to happen without you, the next, like, just stay out of the trade then. Right. If it hits TP1 or what would have been TP1 and then comes back, don't get back in. Okay. But if TP1 never gets hit, feel free to enter the trade. Great. You got risk reward on your side still. It's amazing. So price comes back, triggers you in at order block entry if that's what you were waiting for, and then hits TP1, which was this order block. Why is this an order block? It's the last down candle before the up move that broke structure, right? And even, I mean, it wouldn't broke a lot of structure. It broke this high, right? So it broke a lot of structure. This one order block did. So an amazing, amazing TP1. Price runs through that. Great. You're taking off half your position and going stop to break even. So you're risk free. You've already secured your profits. You've secured exactly what you were risking. Take profit, extended take profit levels. Extended take profit levels would be this next low is AKA liquidity. And then last take profit 3 is right down here, this low right here. So targeting liquidity for both of these next take profits. And as you guys can see, we run through and we tap into TP3, wick past it. And this was a 1 to 4, complete. So guys, that's really it in terms of that strategy. And just to write up a checklist for you guys before we get into the Forex trades is the checklist for S&P 500 is, bias, right? What's your bias for the day? Pre-open. You want to make sure you're not trading during high impact news, obviously. And then you want to see a liquidity sweep, break a structure or an engulfing candle. And then for your, well, let me add to this actually. You could also wait for order block, re-entry, or a fair value gap. So you want to utilize those things, guys. And then for TPs, TP1, risk-free or stop loss to break even. Take off 50% profit. Target liquidity, FVGs, and order blocks. And equilibrium if you want to. So guys, that's the checklist right there for S&P 500. I know it's not super clean, but that's what it is. Bias, liquidity sweep. then get a break of structure or an engulfing candle for your entry point. If you want, you can wait for an order block or for a value gap reentry, and then take profits, TP1, and then extended TPs. Guys, that's super, super, super simple. And then real quick, to get into the Forex trading strategy, super, super simple, guys. The S&P was definitely going to be the longer part of this video, but that's what a lot of you follow me for, which is S&P 500 trades. So just wanted to spend some time on that. So real quick, let's go ahead and draw this up for you guys. So again, thinking in terms of smart money here, I'm going to draw to represent price. Okay. So price is ranging sideways, right? And then during this time, you have retail traders that are developing opinions, right? You've got people that are looking at this as an M pattern. You got other people that are looking at this as a W pattern. You got people that are selling up here, stop loss above. You got people that are buying down here, stop loss below. You've got people that are looking to take a breakout to the upside. So they put a stop order up here, stop loss just under here, right? Stop order up here. And then the same thing is going on down here. People looking to get in down here, stop loss above here. So again, remember I said the market's very efficient. The market is very, very, very efficient. So at some point, while the market is enticing buyers and sellers at the same time to get into the market, it's building up liquidity on either side. And then at some point, right, price will do something to the extent of this. It'll come down quickly, sweeping the stop losses, triggering in the sell stop orders, and then ripping the opposite direction, right? And then it's doing the same thing over here, hitting the stop losses of the sellers and then triggering in the buy stop orders, right? And yeah, it might put some of these people in profit for a little bit, but smart money is very manipulative in the sense of it will give an inch to take a mile, right? So here's how you would want to play this, right? So when you notice this, and let me actually use the square here to draw a candle, right? And we'll make it red. Oops. We'll make it red for this example. So price comes down and wipes these people out and then goes the other way. So here's what people don't know is that this candle that pushed price down before the reversal, that was manipulation, that was the hedge funds, the banks, whatever you want to call it, the algorithm for these institutions, taking a sell position. So they take a sell position to drive price down to get the entry that they want and to get money into the market for them to fill their order. And then they buy it up. Well, guess what? The entire time that this is being bought up, this sell position that they opened up is still open and it's actually in drawdown. So at some point, they need to bring price back at least to the open of this candle. Sometimes it'll go a little bit into the candle, but they need to bring price back to the open of this candle to mitigate and get their position closed at least at break even or a little bit in profit before continuing back in that direction, right? So if I were to draw up how you would trade this, basically when you notice this or you see this pattern, you would put a limit order right at the open of this candle and setting up your position, it would look something like this. Entry right at the open of that candle, stop loss right below the low of that candle. If there was a wick, you would cover the wick as well. And then for take profit levels, you want to target liquidity. You want to target for value gaps, order blocks, all that stuff. But you can get, amazing risk to reward trades by doing this, right? So here's what you would wait to see. You would see price come back right to that level and, maybe even a little bit into the candle, maybe like halfway, something like that. And then boom, price reverses back out and heads for the next level of liquidity or the next imbalance that it needs to balance back out. And this same exact thing happens as well on the on to the bear side as well, guys. So I know I'm showing you a buy example here. The same exact thing happens the opposite direction with this strategy, guys. So one last thing that I'll show you is just a different variation of this because they kind of go hand in hand, these two strategies. So the second one that I'm about to show you guys is honestly not much different, but essentially you'll see price chopping around in here just like this, but maybe sometimes you won't get a poke and then a run the other way. Sometimes you'll just see price just freaking leave this area, but it'll leave convincingly. Sometimes you'll see this happen with news or whatever the case might be. Sometimes price is just going to leave an area, right? Well, guess what? The same exact thing is true, because what you can identify is the very last down moving candle in this example, right? Before the break of structure. Every time you do this, this is an order block that you can use. An order block is when the last opposite moving candle before the break of structure. So boom, last down moving candle, and then a break of structure, price flies out of here, creates an order block, leaves it behind. It's got to come back and mitigate it at some point. Boom, put your entry right at the open of that candle, and you do the same exact setup. Stop loss right below the low, cover the wick if there's one, find your take profit levels, price comes back, boom, and you're in the trade. You can set limit orders this way. I would say that, if you can, it's always good to obviously market execute if you're watching the charts and paying attention, but it is a way to be able to not need to do that if you want to, utilize limit orders, right? So that's how that works. And then as promised, I'm going to show you guys a few examples. Holy moly. Of both of these, and we'll be on our way, guys. So first one I'm going to show you is the banker candle, which basically the banker candle is the first one that I showed you guys, where you get the poke in the opposite way before the run. And then the box trade is actually when it just leaves the zone without doing the poke, right? So just to help you remember them, if that makes sense, but they both do kind of do the same thing. So the first one here, guys, pulling up, is Euro USD on the 15-minute chart. By the way, this works on every asset class and every time frame. So the market is fractal. Everything that happens on the higher time frames happens on the lower time frames. So it works on all currency pairs, on all asset classes. It works on crypto. It works on it. I mean, it works on everything, right? And it works on every time frame. Okay, so just to show you guys this, right? So here you have price building liquidity right here, and all of a sudden price pokes out, comes down, breaks structure, comes right back, put the limit order right at the very last candle, the last up candle before the down move that broke structure. Boom, comes right to the pip almost. Stop loss right above this high. And then where are you targeting for take profits? You could target this low because you got liquidity under here as a TP, right? And then this was obviously another low that you could target for a 1 to 15 risk reward right here. And then price comes down, and you guys can kind of just see how it respects these levels before we're going the other way, right? So that was example number one. And then we have US 30 on the 30-minute chart, or the Dow Jones. Here you see price has some liquidity right here. Boom, gets taken. Price comes down, breaks structure. Okay, great. Here's our last candle before the move that broke structure. So you put the entry right here at the open of that candle. I like to use the bodies because the most of the volume is in the bodies of the candle, not in the wicks. And then stop loss right above the high. Price comes in, again, almost to the pip, and then falls off, targeting the last low. There you go for US 30. All right, here we go for gold on the daily chart, right? So if you're like a long-term swing trader on the daily chart, price runs up, grabs all this liquidity over here to the left, and then falls off, and we get our break of structure right here. So this is the last move up. Price came down and closed below here, guys. So that's your break of structure. Price comes right back up to the pip of this candle, the last up moving candle, falls off, targeting these last lows. There you go. And then the last one here, guys, is USD CAD on the 15-minute time frame. So here you see price push down, right? You have liquidity above these highs. You have liquidity resting under here. Price pushes down in this last move right here. I technically should have screenshotted this on like a 30-minute chart because it's 2 candles here instead of 1. But either way, you guys get the point. Price pushes down, grabs liquidity, and then what does it do? Runs back up, breaks structure. All you got to do is wait. Put your limit order right here at the beginning of that move down. Price comes down to the pip. Stop loss right below, targeting this high, this high. I mean, it's just rinse and repeat. Price comes up, just goes right past it, grabs the liquidity, and then reverses. 1 to 7 risk reward right there. And then the banker box strategy, guys, I feel like you'll probably notice this one a little bit easier on the chart. So this is GU on the 5-minute. Here you got a consolidation of price. Redistribution here, distribution, accumulation, you'll see this happen, right? So you see price consolidating in a range, and then it'll leave the range. Last up moving candle before the down move. Entry right there, stop loss above these highs, targeting this low right here. Boom, GBP USD. NZD USD on the 1 hour time frame. Price consolidating right here, right? price consolidating, price leaves the range. Okay, great. Here's our last up moving candle to the pip. Stop loss right above this candle that we're targeting this low right here. It's great. 1 to 7 played out. Sometimes it's still to this day, it's just like, I don't know, it's like art to me. GJ on the 4-hour time frame. Here we see price consolidated here for several hours, and then boom, left, breaking structure. Price comes back down, boom, taps into this last down candle, stop below the low, runs all the way up to these highs and then some, right? But this was just been a 1 to 5 taking it to that high. And then the last example I have for you guys is GBP AUD on the 1-hour time frame. And here we actually have two possible, right? So here's your box. And you guys can see the price did actually go down a little bit lower than this range, but it consolidated here for, again, several hours. And then all of a sudden you get a abrupt exit of that box, breaking structure, right? This is all breaks of structures, taking highs. And then price comes back down to the pip, right? Maybe it triggers you in here. There's a lot of spread on the exotics, so maybe not. Here you're definitely triggered in. Stop loss either way is below right here, these wicks. Stop loss right below, price runs up. Here's a 1 to 8 played out right here. And if you would have taken all the way up to this high, it was a 1 to 10 played out. So it's crazy, guys. These are literally the only patterns in Forex, if you really wanted to, that you would ever need to know. If you practice these, backtest these, you'll get really good at them. And then obviously same is true for S&P 500, guys. But I hope this was helpful. We do, trades like this every single week in our community. So let me go ahead and I'm going to show you guys really quick. So we have a Discord for our community, and every single week we are looking for trades that all fit within this, right? We trade S&P 500 in the mornings right here in, Chart Talk, posting my personal analysis every single day for S&P 500 trades. And if I see any trades that revolve around the banker candle strategy or the banker box strategy or whatever, right? I'll post them like in our trade signals. So I'll post them because it's easy to set a limit order and then, let it play out, and I'll keep people updated on that. But also the applications in our community are also giving out trades all the time for these trades. They find them for them, automatically based on those concepts, guys. So we're looking for trades. If you guys want to come hang out with us, obviously you can do that. But nonetheless, I wanted to come to you guys with this free training and just provide you guys the strategies completely for free, no strings attached. So hopefully you guys got some value and you can go apply these right away today or this coming week for your trading, and you guys can make some money and capitalize in the markets. But I appreciate you guys. I love you guys. And I'll talk to you guys soon. Peace out.